Let's do it, folks. Good morning, one and all. Welcome to the street today here from Post 35 on the floor of the New York Stock Exchange. Today is Thursday, the 16th of February. I'm your host, JD Durkin. That's what the box in the corner says. I'm here all day. Good morning. Let's do it. We're about an hour or so into the trading session. Stocks are trading in the red as investors react to fresh data on inflation as well as jobless claims. You can't have it all, folks. Some data points indicate things investors want and others not so much. But don't worry, that's what we're here for, to talk all about it and bring you everything you need to know. On the show this morning, we will talk economic data as investors digest reports including inflation, we got jobless, we got retail data early in the week, plus we break down our biggest takeaways from Q4 earnings season, at least so far as the season continues. And finally, we'll tell you why Bitcoin is surging as the crypto market gains over $80 billion just this morning. Okay, for more on those stories and so much more, we now bring in our special guest, Eddie Ghabour. Eddie is managing partner at Key Advisors Group. Eddie, good morning to you.
Good morning. Thank you for having me.
Of course. So we will dig more into jobless claims and PPI and some of these other figures here in just a bit. But what is top of mind for you? Do you think for investors as we're 61 minutes into trading session today and we got a lot of red on the big board?
Yeah, there is. And look, the debate coming into this year is, are we going to have a soft landing or a hard landing? And the bond market is saying we're going to have a hard landing and we're going to see a recession. And the stock market this year has been extremely resilient, and we've seen a pretty sizable bear market bounce. And now we're at a pretty critical inflection point. The dollar's been getting stronger over the last week. Interest rates are starting to spike. I think rates, the bond market kind of sniffed out the CPI number, probably coming in a little bit hot. And the problem now for the bulls is I think the narrative of the Fed pivoting really needs to get put away for now, because I don't think they're going to pivot. We haven't thought they were going to pivot coming into this year. And now the risk that the market has is it was pricing in 2 rate cuts. And now we may, if the economy reaccelerates, that's the Fed's worst nightmare, because they're trying to keep the inflation data down and inflation numbers down. So now we run the risk of them actually raising rates even more than what we had anticipated and longer into the spring and possibly summer. So it's a very tough market because of the mixed signals that we're getting to risk manage through. We continue to play defense and have a pretty good chunk of cash set aside for clients right now. It's nice. It's been a long time since investors have gotten yield on cash and cash-like type investments.
So what are the top questions that your clients are asking you? I mean, I'm sure it's hey, can you help me understand where the puck is going here? Because one day it looks like one thing, one day it looks like something else. But give me a sense about what those conversations actually look like, because that's great perspective that I think a guest like you can uniquely bring.
The biggest question we've gotten so far this year is, why is the market going up when we're seeing the economy slow down? Because there is a disconnect right now with Main Street and Wall Street. I talk to clients around the country, and business owners are feeling the pinch because costs are staying high. Labor costs are high, material costs are high, and demand is going down. And everyday families are still feeling the pinch with inflation. I know a lot of folks are celebrating inflation coming down, and we know that's all great from a headline perspective. But in the real world, these families that are going to the grocery store and having to live their life, they're not seeing a drop in expenses. So we're seeing the economy slow down. We're seeing businesses really slow down. It's just not been reflected in a lot of the economic data yet. And I think that's what we're going to see here over the next 6 months is, I think you're going to see the stock market catch up to what's actually happening on Main Street. Because right now, families are struggling and businesses are seeing a slowdown. And that's why we believe we're going to see earnings decelerate over the next 6 months. We're going to see GDP head in the wrong direction, unfortunately, in our opinion. And it's going to be a pretty tough economic backdrop this year.
I mean, is there any power to the idea that investors might say, all right, well, we know that people are struggling, but look how easy it is to get a job. I mean, can you not just easily look at another data point if you wanted to? I'm not advocating for this, my goodness. But couldn't you just say, well, my God, there's 11 million some odd unfilled jobs?
No, you're exactly right, and that is a valid point. And what I will say to rebut against that is the labor market is always tight. It's the last thing to break when you go into a recession. And without question, the labor market is much tighter than normally you would be in this cycle. But what's interesting is when you're seeing the companies that are laying off jobs, you are seeing your higher paying jobs getting laid off right now when you look at all the tech companies. So it's going to be interesting to see how long it takes for the labor market to crack, because there is a scenario, and it's playing out now, where the labor market can continue to stay tight while the economy is slowing down, while earnings are slowing down. But why that works against the stock market is that means the Fed has to keep the pedal to the metal in regards to tightening monetary policy. I don't believe there's ever been a time in history where a bear market has ended, and you can fact check me on this, where we've seen the yield curve disinverted while the Fed is tightening. And so the probability of the bear market ending at this stage of the cycle, we believe, is a very low probability. And this is why we're so defensive, because we do think we're going to have some attractive buys this year if we are correct in our thesis of a recession this year.
Well, by the end of our conversation, I will ask you about those potentially attractive buys, as of course we do roll along here in 2023. Specifically, a big piece of key data. There we go. Words are tough. PPI, Producer Price Index, rising 0.7 in January. That's a lot above expectation of 0.4. What are your main takeaways from that report and the impact?
Yeah, look, when you take a look at not just that report, but the labor market reports, the retail numbers that came out, CPI, that points to the fact that unfortunately the Fed's job is not done. And I think we're going to run the risk, and I think it's going to probably happen, is they're going to over-tighten. And anytime you over-tighten during an economic slowdown is when there's a disconnect in regards to what happens to the markets, and you could see certain sectors really crash and hit new lows. And that's just the unfortunate reality that we're faced with right now, is that we have to get used to this new normal of the Fed's not coming in to save the market, and we have to calibrate to higher rates and higher inflation for a longer period of time than when we've been accustomed to. Because I would argue, it's been 40 plus years since we've seen an environment like that. And we've been conditioned to believe that the Fed's going to come in and save the day, but we haven't seen inflation like this for a while, and it's going to stay very, very sticky. And this data shows that. And the last thing the Fed wants to see is things to reaccelerate, because that would mean they did all this work for nothing and run the risk of what happened in the 70s. And they've been crystal clear that they want to do everything they can to avoid that from happening, which means the only way, in our opinion, you get this data down to where they want it to be is to have demand destruction, which leads to a recession. Mathematically, I don't know how any other way we get to 2%.
What is the worst case scenario, the nightmare scenario, if you're Jay Powell right now?
So the nightmare scenario is probably playing out right now, where they were hoping that the work that they've done would start to show and not see some reacceleration. But the worst case is the labor market stays really, really tight, and the inflation data stays very sticky, while earnings in the markets are heading in lower direction if that actually happens. Because now you could say that there is no Fed put in that environment. Again, we've been conditioned to believe that if the market's down 30, 35%, they're going to come in to save the day. Well, if the market is doing that, while the labor market is tight and while inflation is still hurting everyday families, they're going to pick CPI and the labor market over the stock market. And I think that's a worst case scenario, because then that could lead to credit events and things that we hope does not happen this year.
We are about 5 weeks or so. I don't have a calendar in front of me. I think we're 5-ish weeks, maybe, 5 and change from the next FOMC meeting. What have we learned since the last meeting that you think may change their decision making a little bit, if anything?
So in their last meeting, which was taken by the market as being dovish, is they were going to start really relying on the data to determine where their rate hikes are going to be. Well, the data is showing that the economy is hotter than where they would like it to see. And so I think they're going to continue to pound the table on the narrative that they're not going to stop until the job is done. He has said that repeatedly. They have repeatedly said 2% is their target, and they're not going to stop until they get there. But the market doesn't want to believe it, and the bulls don't want to believe it. We have to take the Fed at their word. They've done everything they said they were going to do, whether you agree with it or not. And I believe they're going to continue, especially if this data stays the way that it is, where they may come in and just really be extremely hawkish to get the market to understand what direction they're heading in. And they're not going to stop until they get the data down to where they need it to be.
Eddie, one of the things that I like to talk about a lot is that when you watch Chairman Powell speak, he uses the phrase historical record a lot, right? He says the historical record strongly argues against prematurely loosening policy. And you mentioned the 1970s there a few moments ago. Can you give us a bit more of the perspective of what you think the historical record is that
So
he would like to avoid? And is there any of it that he would like to replicate? In other words, has there been any Fed chairman in particular he says that person did it right?
So unfortunately, the Fed has a track record of over tightening. This is why they have to come in and cut rates, because they over tighten. And so I think that they would rather over tighten, unfortunately. And he has said that in his press conference when they've asked him that question. He would rather err on this caution of over tightening, because he does not want to be remembered as the Fed chairperson that stopped too soon and caused inflation to reaccelerate, and then have the Fed have to come in with both guns blazing and just have a Volcker-like moment. He wants to avoid that from happening. And the only way you can avoid that from happening, in our humble opinion, is by over-tightening. So even though that's not probably what the market wants, and the economy's not going to want that, that is the only path they have to avoid that. And it goes back to the fact that they waited too long to tighten. We have never in history seen the Fed raise rates this fast in this short a period of time. And that is one of the concerns that we have, is we haven't even seen the impacts yet of all the tightening. And they're still going to tighten at least maybe 2 times, he said in the last press conference. Now maybe 3 more times if this data stays hot.
So that lag effect is exactly what I wanted to ask you next. Can you line it up on a timeline? So if you and I are having this conversation on February 16th, we're right here smack in the middle of 2 FOMC decisions. The impact the market is feeling right now is a result of a tightening of policy when? Because we know there's a lag, right? They're not on the same trajectory timeline-wise. How far behind are we in terms of feeling the impacts, which might give the Fed a bit of a clue as to when to not necessarily pivot, but at least begin to slow things down and see how the dust settles?
Personally, I think they've done enough work right now where it would make sense to just wait and see what happens. It's impossible to see how many months out. But again, if you look at forward-looking data and you look at the rate of change of earnings and consumer debt, late payments on credit cards, car loans, the slowdown in housing, I think if they would just stop, the economy would have that softer landing scenario. But unfortunately, they're looking at rear view mirror data, not forward-looking data. When we make our allocation changes and adjustments for clients, we're looking at forward-looking data. And the forward-looking data is telling us the Fed's work is getting done. Things are heading in the wrong direction, which is what the Fed wants to see. But unfortunately, they don't look at it that way. They wait until the data actually shows, but by then it's too late.
So I'm assuming you're not in the camp of expecting any cuts for the year. That's off the table at this
No,
point.
it's off the table. But again, here's where I want to kind of talk about these rate cuts, because I've heard that as a bullish stance on the market. Be bullish because the Fed's going to cut rates. The Fed only cuts rates when things get really bad economically. So we have to have an extreme bear market and a really bad economy to cut rates. Why else would you cut rates unless you need to stimulate the economy? So they will ultimately cut rates, but it will be when we have had some pretty bad economic data hit the print and the market's probably in a bad spot.
I mean, one of those data points, at least judging by history, of course, could be unemployment. Now, right now, you're at a record low of 3.4%, the lowest it's been since 1969. Correct me if I'm wrong, but the historical record, to use Mr. Powell's phrase, often means that you dramatically and virtually overnight cut rates because you've had this sudden high spike in unemployment. It just doesn't, I mean, I don't think anyone can imagine having 3.4. God forbid, I'm not putting this out there. But God forbid you have this massive jump in unemployment month to month, and we go from 3.4 to something off the charts, right?
Yeah, and if that happens, again, you're looking at a world where the market is going to be, in a bad spot, and the Fed's having to come in and save the day. So they're really in a tough spot, right? They're damned if they do, they're damned if they don't. And it's like you get good data, and it's looked at as negative because the Fed's not done doing work. So again, they're in a tough spot, and unfortunately, a lot of this is stemming from the fact that we did, I think, wait too long to start tightening, and now we're in this spot where we had to tighten too fast and not allow the economy time to absorb these cuts that they're doing, or rate hikes and things that they're doing to this market. Because the biggest thing I'm worried about is credit. It's tightening. And when that happens, you really start to see things materialize that can hurt the bottom line. And that's why we're paying such a close attention to the real estate market right now, because I don't think there's another sector that touches more parts of the economy than real estate. And when you continue to raise rates and tighten policy like they're doing, it can be very detrimental to that space.
Could you give us a little bit more context on what you refer to when you say credit tightening? I mean, we understand it, but I'm wondering for viewers watching at home, they say, what metrics, what are you looking at that gives you that indication? Because I think we're also in this era where, last calendar year, in the last 18 months or so, people were probably still spending a lot of their either stimulus money or the helicopter cash or whatever little, extra discretionary spending built up at home during the pandemic. But that's likely running out this year at some point, if it hasn't already for many households. But the credit component is really interesting. Are you willing to dive into that a little bit for us?
Absolutely. So there's so many components. Just look at the households first. Folks have credit cards and lines of credit that have balances, and the interest rates on those have increased, some by double. And that means households maybe can't afford to pay that, and that means the banks may not lend them any more money. Okay, so they're seeing the tightening on that side. You're seeing lenders not loan as much money out as well, too. And the other fact of the matter is this: you look at the corporate debt side. There's massive amounts of corporate debt. And if you have companies that are barely making it or their profits are decelerating and they have to refinance their debt, they may have to pay 2 and 3 times the rate if the lender will give that to them. And that's where you see a big problem, because how can you double the cost of capital for a family or a corporation and not expect that to hit the bottom line in some form or fashion? And we are just starting to see the beginning of that. And again, mathematically, I think if we take a step back and look at it logically, when you double the interest rates for families on lines of credits, you see credit card rates increasing, car loan rates increasing, mortgage rates increasing, that extra money has to come from somewhere. So that means you're going to see a lot of discretionary spending kind of go by the wayside, in our opinion, over the next several months. And then the corporate debt side, again, that's where we're most concerned with from a market standpoint, because how do you refinance that much debt and not expect something bad to happen to some of these companies that aren't profitable?
Cleveland Fed President Loretta Mester had comments early this morning. She expects inflation to reach the goal of 2%. And this is the headline note, in the year 2025. Eddie, I assume that's not the timeline many people want to hear, correct?
No, it's not, because again, that means tighter for longer, and it stretches this out, and it makes it a more challenging environment. Unfortunately, the best thing probably for the market and the Fed and the economy is a quicker, shallower recession so we can start back over again. But the longer this stretches out, the more challenging it's going to be for businesses, markets, and families. And, you'll start, to your point earlier, start to see that unemployment number really tick up. Because, again, business owner after business owner that I speak to continue to tell me the challenges they're having with the cost of labor and demand slowing down. And if rates stay higher for longer, you have to only assume that that demand destruction will only get worse over the next several months as the consumer gets tapped out from the record levels of savings that they've been blowing through.
Yeah. Okay, let's pivot here to earnings. Your biggest takeaway so far from the season, keeping in mind we still have some key, especially retail names coming out before all said and done. But we've learned a lot. Some of it good, some of it not so much. What stands out to you?
Yeah, so I think the earnings picture has really kind of been the same thing the market and economic data has been. You have seen mixed signals, One in particular, Microsoft, when they came out with their earnings on their earnings call, they talked about the consumer side of their business, seeing, I believe, approximately a 40% reduction. On the retail side, interesting thing with retail is they have seen inventory spike significantly. So you wonder, the consumer, when they spent this money on retail, did they put it on credit cards? Did the retailers actually make money or just sell product to get their inventories down? So, the energy sector had strong earnings for the most part. But I think the main takeaway overall is the market was really pricing in really bad earnings. I don't think many hit them right out of the ballpark. They just weren't as bad as some of the market was pricing in. And so that was a scenario where not so bad news was considered good news from a market standpoint. But I believe you're going to see earnings get worse over the next 6 to 8 months, those especially that their business is driven by the consumer for the various reasons I shared with earlier on the impact of the credit tightening for these families. I just don't see where the discretionary income is going to come in to support some of the levels that we're at, which is why I think we're going to get a repricing on this market here in the near term.
Are there certain companies or sectors during earnings season, Eddie, that you pay more closer attention to than others?
I think you have to take a look at it globally, right? You can learn something from every sector, really, because when you're coming up with your conclusion, you have to try to look at all of the data. And when we kind of take all the data and put it together, again, this is where we're coming with the conclusion. We are a consumer-driven economy, whether we like it or not. And company after company continues to talk about the fact that they are seeing a reduction in consumer demand and what they're spending. And look, this is why you're seeing companies lay people off. You don't start laying people off and making cost cut decisions because you think you're going to see an acceleration in earnings or demand. You're doing these things because you're trying to prepare for a slowdown. And so when you start connecting all the dots on why are these companies trying to cut costs and lay people off, it kind of again points to that same thesis, is because they're expecting a material slowdown. If they didn't think it was going to be a material slowdown, they would wait on doing the job cuts and cost cutting. But it's prudent for a business to prepare for a slowdown. And I think you're going to see more and more companies come out and do the same thing if we see the deceleration in GDP that we expect to see in the coming months.
All right, a few more general questions for you before I let you go. And you've been very generous with your time. People are wondering, where's the dip? When do I buy? Is this the buying opportunity, or are you holding out for a little bit longer?
We're holding out. We actually think this is not a popular opinion. And we went bearish in December of 21 when we felt like 2022 was going to be a very tough year because of the tightening of monetary policy and the slowdown. And now with this bear market bounce that we've seen, when we look at the things that have bounced the most, a lot of these are companies with, I would say, not so great balance sheets and more speculative plays, which tells us, in our opinion, that it supports our bear market bounce thesis. So I think we're going to hit new lows before we hit new highs. So we're going to be patient here. Like I said, the yield on short-term treasuries and cash is the most attractive it's been in a long time. So our clients are very comfortable with us playing defense, because I would rather be late to the start of a new bull market than early. Because if you're early and it's just a head fake, you could see 20 to 30% downside from there. So you're never going to pick the exact bottom. We know that. However, we need to see this economy start to show signs of bottoming. And I think we're just seeing the beginning signs of a deceleration. So we think we'll see better opportunities here sometime in the second quarter.
What are some of your tried and true investing tips that you are carrying into 2023?
Just discipline, follow your process. We have a process of risk managing client assets. And look, as human beings, when you see these bear market bounces, it's tough, right? Because then you maybe second guess yourself. But then you go back and look at a process, if it's a proven process to work, and if you stick to that process, chances are you'll have a really good batting average. And look, trying to pick tops and bottoms, in my opinion, is impossible. But it's not impossible to put together a process. So that way, when you go to start buying, your dollar cost averaging in, and that's when you go bearish as well, too, you dollar cost average out. Because trying to go all in and all out at one time, I believe, is a very, very difficult thing to navigate. And that's not how we risk manage the millions that we manage for our clients.
Of course. And of course, they say in the world of baseball, if you're successful 30% of the time, you're a Hall of Famer. Although I'm sure you'd probably like numbers a little bit better than that. All right, finally, what are some of the most attractive sectors on Wall Street right now?
So look, I think when you take a look at what's going to be attractive here over the next few years, I do think the energy space is going to be attractive. They've got some tough comps coming up this quarter on earnings. So again, we're being patient there. And we're really going to be looking at areas that we think are going to be able to generate some nice dividend yields, because I think ultimately that's where you're going to see on the value side But look, the other thing we're watching is tech. Tech, in our opinion, is going to continue to take the biggest hit if we're right in our thesis. And we may have an opportunity like we did in the 08, 09 scenario or tech bubble burst back when we were managing assets to get in on some sectors that are very attractive. So you would look at more of a risk on trade, your higher beta names like the small caps, energy space, tech, discretionary items versus your more defensive staples, because that's where we've been for quite a while now, is the staples and utilities and treasuries. And we'll be looking to pivot out of those defensive names into more of a risk on strategy, again, when we feel like we've bottomed out, but we're not there yet, not in our opinion.
Eddie, absolutely. Eddie Ghabour is managing partner at Key Advisors Group. Thanks a lot for the great perspective, Eddie. It was awesome to have you today. Appreciate your time.
Thank you. It was my pleasure.